The stock market is one of the most alluring places on earth. The promise is simple: buy low, sell high, and watch your money grow. But beneath the glossy headlines and viral success stories lies a darker reality, a minefield of mistakes that have cost ordinary people billions. Beginner investors enter the market with dreams of wealth, only to find themselves trapped by pitfalls they never saw coming. Some lose everything in a single trade. Others slowly watch their savings erode, all while believing they're making progress. This isn't fear-mongering. This is the truth every new investor needs to confront before risking a single dollar. Because the stock market doesn't care about intentions, optimism, or luck, it only reacts to strategy, timing, and discipline. And for beginners, that makes it brutally unforgiving. Let's start at the beginning. Imagine stepping into the market for the first time. You're excited. You've read stories of young millionaires turning $1,000 into $100,000. You've seen TikTok clips of someone buying a hot stock at $5 and selling it at $50 in weeks. The adrenaline kicks in, and suddenly, logic takes a back seat. The first mistake? Buying on hype instead of research. Hype is seductive. Social media, Reddit threads, and financial influencers are everywhere, promising instant riches. A stock shoots up 30% overnight, and beginner investors panic. Not in fear, but in greed. They buy at the peak, ignoring fundamentals, valuations, or even the company's financial health. They're caught in the trap of FOMO, the fear of missing out. And then, the inevitable crash comes. Every stock that skyrockets purely on speculation eventually falls. Investors panic, sell at a loss, and swear off the market forever. It's a brutal lesson. Hype can make you rich, or it can make you bankrupt. But hype isn't the only trap. Another massive mistake beginners make is ignoring risk management. Every trade carries risk, yet most new investors pile everything into one stock or sector, convinced that their gut feeling or a hot tip will pay off. One subtle, often overlooked mistake is ignoring research and relying on instinct. Successful investing isn't intuition, it's analysis. It's understanding the company, the industry, the competition, and macroeconomic conditions. Beginners often skip this step, assuming that buying a stock everyone talks about is enough. But investing without research is like navigating a minefield blindfolded. You might get lucky, but chances are you won't. Let's not forget leverage, which is, honestly, a hidden predator for many beginners. Buying stocks on margin, using borrowed money to amplify returns, might seem really tempting. One small gain multiplies into a huge profit. But the flip side? Losses are amplified just as quickly. Margin calls can, wipe out portfolios overnight. Beginners often underestimate the risks, overestimate their skill, and, pay the price in full. Another danger is, failing to set realistic goals. Beginners often enter the market expecting astronomical returns. They're told stories of 100% gains, and they assume that's normal. When reality hits, 5%, 10%, or even a steady 20% annual return, disappointment can lead to impulsive decisions, unnecessary risks, or even abandoning investing altogether. Markets reward patience, not desperation. Overconfidence is another silent killer. After a few small wins, beginners start believing they've cracked the code. They ignore warnings, increase positions, and take risks they really shouldn't. Overconfidence can lead to catastrophic losses. The market has a way of humbling even the most arrogant investors, and beginners are, honestly, prime targets. And here's a mistake that's rarely discussed: failing to track progress and learn from mistakes. Investors might buy and sell dozens of stocks without ever reviewing what went wrong or right. Without reflection, patterns repeat. Without discipline, lessons are wasted. Beginners often don't maintain trading journals or take the time to analyze their outcomes, and this, unfortunately, traps them in an endless cycle of losses. Diversification, again, really deserves emphasis. Not just across sectors, but also across asset types, like stocks, bonds, ETFs, and index funds. It's pretty common for beginners to treat individual stocks almost like lottery tickets, just hoping for that big jackpot. A portfolio without diversification is, fragile. It's vulnerable to volatility and much more prone to emotional decision-making during crises. Then, there's following the crowd blindly. Social media and financial influencers are double-edged swords. While education is valuable, advice often comes without accountability. millions of followers, viral posts, and trending stock tips can drive massive buying sprees, which is really a setup for spectacular losses when the bubble bursts. Beginner investors often lack the discernment to separate hype from substance. Education, or the lack of it, is honestly the foundation of nearly every mistake. Many beginners just jump in without understanding basic principles, like how the stock market works, how earnings reports can affect prices, or even how macroeconomic trends might influence entire sectors. Learning the fundamentals isn't really optional, it's survival. Another trap, and it's a big one, is ignoring risk tolerance and personal finances. Beginners sometimes invest money they simply cannot afford to lose, like savings meant for emergencies, retirement, or even essential living expenses. Emotional and financial strain can force them to exit positions at the worst possible time, turning small mistakes into life-altering financial damage. Finally, many beginners underestimate the power of patience and compounding. Wealth in the stock market isn't built in weeks, it's built over years. Short-term thinking drives mistakes, long-term thinking creates opportunity. Those who ignore this principle often chase fleeting gains, ride high-risk trends, and burn out before seeing meaningful growth. So, what's the takeaway? The stock market can reward discipline, patience, and knowledge, but it punishes ignorance, impulsivity, and overconfidence. Beginner investors must respect the power of research, the reality of risk, and the limitations of human psychology. Avoid hype, diversify, set realistic goals, manage risk, and always learn from mistakes. And above all, understand that slow, consistent growth is the only reliable path to wealth. The most successful investors are not those chasing the next hot stock. They're the ones who study, plan, and stick to principles even when emotion and noise scream for action. Warren Buffett, Peter Lynch, and other legendary investors built wealth not by luck, but by patience, discipline, and avoiding the very mistakes so many beginners repeat. If you're just starting, remember this: the market doesn't care about your enthusiasm. It doesn't reward optimism alone. It rewards preparation, strategy, and vigilance. Each decision matters. Each misstep is a lesson if you're willing to learn. Before you invest another dime, ask yourself, am I prepared to face volatility without panic? Do I have a strategy, a plan, and an understanding of what I'm buying? Do I respect the risks as much as I dream of the rewards? Because honestly, failing to do so is a mistake that could cost far more than money. It could cost your financial future. Beginner investors beware. The market is a teacher, but its lessons are often painful. Ignore them at your own risk. And here's the final call. Start your investing journey with knowledge, not impulse. Read financial statements, track your trades, study market cycles, seek advice, but always verify it. Build a diversified portfolio, protect yourself from emotional trading, and most importantly, be patient. Wealth built in haste often collapses in ruin. If this breakdown helped you see the unseen traps beginners face, do something proactive. Like this video, subscribe for more deep dives into investing mistakes, and share this with a friend who's thinking of stepping into the stock market. Knowledge compounds faster than money, and the right lesson today could save thousands tomorrow. Because the stock market isn't about luck, it's about strategy, patience, and avoiding the mistakes that trap beginners again and again. Learn these lessons now, or pay the price later, and in investing, the cost is never cheap.